Hello and welcome to the KE Report. Shad and Corey here as your host, and today we're talking with our friend and colleague Erik Wetterling, also known as the Hedgeless Horseman. And we will put a link to the Hedgeless Horseman down below so you can follow along with Erik's work. And Erik, it's always great to get you on the show just to get what's on your radar in the resource sector. And we were talking off mic a little bit about the dichotomy between people that have a lot of, let's say, producers and development companies and royalty companies that have re-rated higher with the higher gold and silver prices or higher copper prices versus people that may be sitting in exploration stocks that may have moved a little bit, but maybe not had the same kind of moves because they always get punished the most in a bear market and they're always the last stocks to move in a bull market. And a lot of them are catalyst driven. So you're looking at the market and your portfolios more from the vantage point of catalyst, news, key milestones that are coming that could really accelerate some of these exploration stocks higher. So maybe just in a general sense, walk us through how you're looking at things and why higher metals prices for you aren't as big of a deal as news from the companies.
Right. To begin with, most people don't really understand this sector. And I would think most people basically don't have really good cases or any cases at all for most of their holdings. They're just hoping that the narrative of, silver is going to go to $100 and gold is going to go to wherever, that's just going to bail you out. So, the only thing in that case you're really looking forward to, your whole case is that metals are going to go to the moon. That's the upside in your case, and all your shit and not shit and maybe some good companies are going to be flying. And now they're obviously starting to fly across the board somewhat. So it's like that, I get then why you're really excited about that, because you're not really excited maybe about any potential catalyst, not what the actual value of the company is, not what they might be developing over the next 1, 2, 3 years. You're just waiting for sentiment and metals to go up. And there's a lot of people who, when you see what their cases are for some holding, it's like, if silver goes to this level, this whatever company could go up 3x. So when that's happening, that's your the positive side of your case playing out. Whereas, every holding I have is everything is based on fundamentals. So, I'm excited about every holding I have because what value I think they have in the ground, how undervalued they might be to what they have in the ground, but more importantly, what could happen in terms of news flow over the next 1, 2, 3 years. So it's like, if they're going to be success cases or not, that's still up in the air basically. So if my portfolio, let's say if the upside case in my portfolio happens, it means that the fundamentals have developed or, along the base cases I have for them. So, I do the micro first and then the sentiment and the metal prices going higher. That's the bonus in a sense. So but it's not actually my main cases. And of course, since I'm starting to, like we talked, I think last week, now I'm starting to finally go more into the exploration plays again, the alpha plays. When birds in the hand gets revalued, it's starting to get worth it to look for birds in the bush. And this is actually the part of the sector I actually mostly enjoy, I was going to say, to invest in. But they're the ones that crash the most, especially the earlier stage, because at the lows, nobody thinks any risk whatsoever is okay. So if all you have is potential, that means you have no value almost in the eyes of the market. Whereas when the sentiment changes and people are looking for excuses to buy and looks for risks to the upside, then all of a sudden potential gets revalued. And at the very high peak sentiment, some of I think from bottom to top, it's going to be some exploration stories with the most amount of blue sky that's going to go up absolutely the most from bottom to top. Even though, how often do I buy an actual bottom and I don't usually get out at a top? But that's just how sentiment works. People, when stuff is run, people are going to look for other stuff that could do the same journey in a sense. So yeah, so it's crazy. When I look at the gold price, it feels crazy. It feels surreal to see what it's doing right now. But I don't care too much because again, some of the cases I have is like 3-year cases or something. So 1 day's worth or 1 week's worth of upside. And if it's on no news, really, I mean, it doesn't really change that much, except that, yeah, risk reward is maybe getting a bit poorer. And that's, I mean, you have paper profits, but that also means opportunities are going away.
Yeah, welcome to a bull market, Eric. This is, as we said, a full-on bull market and has been now for a little while, and it's starting to trickle down to the juniors. And look, you do come on the show a lot, mentioning a lot of exploration companies, and those, whether it's a bull market or bear market, really do depend on news. Curious your thought, though, on this environment where pretty much all of these exploration companies have cash in the bank. They have drill programs either ongoing or starting in the near term. How are you separating what drill programs actually matter? Is it jurisdiction? Is it already built-in resources that they're drilling around? Just what fundamentally are you looking for in these exploration companies, again, that are going to be led by news and drill results? What rises to the top for you?
Well, in terms of position sizing, it's always the risk that dictates that. And I still think birds in the hand are not expensive enough that any random drill play is worth it. I mean, because if you look at how hard it is to actually find a tier 2 deposit or even tier 3 deposit, let alone tier 1, that's extremely hard. It takes years to prove up, and it costs quite a bit of money, depending on the system. So I still think that the exploration stories, I want to, especially the earlier stage, they have to be kind of at least tier 2, tier 1 potential. And I mean, my preferred, if we're talking preferred place, it's the ones with optionality, where you're buying some company that has ounces in the ground, maybe even have something worth mining, and it's not even, it's not overvalued by any stretch of the imagination, especially not to where gold is right now, at least, even though most of them won't be in production anytime soon. And then I get all the exploration potential for free, because that's just added risk-free upside. Because let's face it, I mean, if you buy something that you think is worth 500 million, you buy it for 200 million. Compare that to buying something you think also is worth 500 million right now for 200 million, but they have a lot of exploration upside. So that 500 million over the next 3 years could be 1 billion, for example. Then I would much rather own the second play, because there's free optionality in that. But I mean, I like big targets, really good targets. And of course, the cheaper they are, the better, because that means I need fewer success stories. I mean, Red Canyon, for example, they just announced that they're starting to drill at Kendall in BC, Canada, and it was announced that the multinational that was taking a 9.9% stake in the company was Tech Resources, or Tech Mining, whatever they're called. And I think they have a market cap around 26 billion. So if you looked at Red Canyon, they have a market cap, or had a market cap, of 10 million. And $26 billion company is funding them. I mean, do you need, it doesn't take a rocket scientist to appreciate that there might be some considerable upside there, and you don't need to be right on a lot of those ones to make it, but you need to capture the upside. And that brings me to another one. I participated in a few placements of a small junior called New Break Resources, and it was one of those, spread betting. They looked to have a good target. They were looking for a young Davidson analog. What are the chances they're gonna hit something, and hit something soon? I don't know, 10% maybe, 15, no idea, but they were trading really cheaply. And now, I think it was last week, they announced that they had hit 4.11 grams per ton over 31.3 meters and 3.35 grams per ton over 14.8 meters. So if you look at the Kennerland discovery study, that's very, very material in such a small drill program. So I think it went up around 100% or something after the discovery. And whereas, like, I do think a lot of people get themselves into these stories, and once they pop on a discovery, they're like, okay, I made my money, I got a 100% return. Whereas, like, I think that's a totally wrong way to go about it, because if 1 in 10 actually makes a discovery, let's say, so 90% are going to fail. If you just get 100% on the few success stories, that's not going to pay. You're going to be basically massacring your portfolio over time. So I actually added some, and not a huge amount, but it's like, I mean, hopefully this is the start of something. And my point being that you need to capture the reward side to pay for the high risk. Otherwise, it's just a high risk, low reward or medium reward strategy. And that's one of the worst strategies you can have in this sector. And I did that strategy, I think, early on, where I bet pretty big, actually, even going into maiden assays. And if one was lucky to make it, make a discovery hole, I either sold or planned to sell if it was up 100%, because I thought, 100% return, that's great. But if you look at it, it's absolute foolishness to have a high risk, high reward portfolio run like that, because the reward side of the stories are never going to pay for all the risk you're taking.
Eric, let's talk on that string just a little bit further. We were talking off mic about this one with NewBreak and that you added to your position. You've mentioned that on the show a couple of times, and I've heard a couple other savvy investors do the same thing, that post-discovery, if a company has a thesis, they go out and they hit pretty early on, like you're saying in that Kennerland study, it's unusual to come out of the gate swinging, and if they do, they're probably onto a good system because it means that wherever you put a hole, you're going to find some mineralization. So you actually pressed your bets there. There's a lot of people that do just the opposite and just what you just talked about, where they're in pre-assays, the company makes a discovery, and they think, okay, wow, it's up 100%. In the case of NewBreak, if you go back to August, this thing's up 4x. It was at 8-9 cents. Now it's at 32 cents. So it's up 400%. Do you think if people were in from that point and they had a 400% gain, that they should start ringing the register? Or are you in this thing for the 10 baggers? I understand what you're saying. You got to bail out the losing positions. But if somebody was up 400% in this just after a couple holes, isn't that a win?
Sure. I mean, and that kind of also depends on your strategy and the risk you think you're taking. I mean, if I thought that there's a 50% chance that they're going to hit something, then I don't need to wait for 500% returns, because then 1 in 2 is actually going to make a discovery, and if I can get 150% or something, then that's okay to take profit. So it's what your estimation is that the risk is and the chance of reward. I just think, I mean, for me personally, I think I'm over optimistic what the chances of success is, and I guess that comes from greed, because I bet big on Condor, for example. I thought it was, and who knows what the odds were, but I thought it was at least 30% that they were going to hit something right off the bat, and they didn't. And again, nobody can tell you what the actual chance was or risk was, because what is there has been there for millions of years and has not changed. So we're just working with incomplete information. And of course, that also, what skews the risk reward is, of course, if you have warrants, for example, that skews it big time, because you'll make more with or on less of a rise. But at the end of the day, it still comes down to price. I mean, I think NewBreak, for example, is at 20 million CAD. We know, for example, Onyx, which recently had a good discovery, they went up to 140 million. So I'm just, to make it easy, if you have 20 million CAD in market cap, you have a project, in let's say the heart of a Canadian gold belt, and you hit something that's statistically very impressive, and you think, hey, there's a chance that this might be a 1 million ounce gold deposit with good grades and mills around. It's like, what could that be worth? A bit higher than 20 million CAD? Yeah, I think so. So, I mean, if NewBreak went up 400% to 100 million or something, I would be probably sold everything. But 400% or whatever it was to 20 million, I mean, I don't think, if this turns into something really good, this is not even going to come close. And I'm not saying I'm not saying I'm all in on this. I'm just saying, I mean, it looks very promising, and a 20 million market cap, I mean, there's sure plenty of upside left. So until it really, really gets ahead of itself, for example, or some new information comes out that, this target is actually not that big or something like that, yeah, then I'll be, let's say, quicker to sell. But I'm in no rush selling anything that hits maiden assays like that in Canada for 20 million market cap.
Eric, I'm curious what kind of benchmark you use for looking at these exploration plays? You go through so many exploration plays, and when it comes to drill results, the benchmark that a lot of people use is this 100-gram meter hole. So you take the grams per ton, times it by the meters, the width, and that's the number you get. I've noticed recently we're seeing so many good drill results out there. 2, 3, 400-gram meter holes. Seems like that 100-gram meter hole, it's a very good hole still, but it's being blown out of the water by some of these other drill plays that, quite frankly, are just knocking it out of the park. Maybe that's the difference between tier 1 and all the other types of deposits you can have out there. But do you have a benchmark that you use that you say this is meaningful rather than saying, this is good, or this is simply just not a great drill result?
Well, I don't have any fixed rules really about anything. But I mean, I do like to, when we're talking assay results, yes, I really find the Kennerland study interesting. And of course, I mean, context matters as well. Where is the project? What's the threshold for success? Because, like, let's face it, remember Snowline and recently Rattler. I mean, they're in very remote areas. So it's like if you take whatever, 50-gram meters, a 50-gram meter hit somewhere in Nevada versus a 50-gram meter hit in remote Yukon. I mean, same assays, but completely different cases. I mean, I know some geologists who said, what do you call a 3 million ounce deposit in the Yukon? You call it a soil anomaly. Whereas, like, if you find 3 million ounces of open pitable oxide in Nevada, that's $2 billion mine, basically. So I don't have any strict rule of thumbs. I do look a lot in terms of context, and the same goes for, let's say, Red Canyon. I mean, if tech is in there, it's like, how much more do you need to know? Or if Lundin takes a position in some companies, like they've done all the due diligence for you. It doesn't need to be much harder than that. But what I think we do a lot of, I probably did as well, is like we're so greedy that we're looking for that, I don't know, total sleeper, and it's like, hey, this could work, yada yada. Where it's like there's a bunch of good real plays out there with good people, third-party validation, etc. And I mean, that goes a long way, because there's sure going to be a lot of crap exploration companies that don't have any, let's say, good people involved and no third-party validation. They might put out a hole, and you don't know if are they maybe twinning a hole? Has this project been drilled a bunch of times before, or is there some fatal flaw that everybody else knows and the project's been around, in 7 iterations or something, and it doesn't matter what they hit, because that's never going to become a mine. So there's so much more, I think, than just actual assay results, because I've seen some really good assay results, and then I quickly look into the news release and I can't really, maybe there's no drill sections, or maybe I don't recognize any of the people, or I do recognize them from other shitty plays. Then I simply won't touch them, because I just assume that there's something wrong here, let's say. So there's a lot of stuff that goes into it, and that's why, I mean, I keep coming back to the fact that, especially the less you know, and I'm not a mining engineer or geologist, but third-party validation, for example, is so important. If you see, in this case, they don't have a major invested, but if you see a major investing in a drill play, I mean, they've done all the due diligence for you. Take Onyx, for example. They got, I think, Alamos Gold in them. Went in there a few months ago, I think. So it's like, yeah, they're probably the best at what they do. They're saying there's Alamos Gold type potential in that discovery. It's potential, of course. It's not a guarantee, but that's as good as it gets.
All right, Erik. Well, I think we'll wrap it up there. Some good points that it's not just about the drill assay gram meters. It's also about the third-party validation. Who is on the management team? Has this deposit already been drilled in the past and is regurgitating the same old news and pulling the wool over the eyes of investors that haven't followed it? Or is this a brand new discovery in a new area that had a thesis behind it that has been vetted by a couple layers of the scientific community, whether it's geologists or different rock samples or surveys? So there's a lot that goes into it to parse out these drill plays. But I like the overall message that you have, that even in a raging bull market for gold and silver, some of the best exploration stocks haven't really got off the launch pad yet because their whole thesis is based on news, on catalyst, on pressing the bets, and that sometimes after they make a discovery, that's when you really want to hit the buy button rather than the sell button. So a lot goes into it, but I appreciate you sharing the way you view some of these different exploration opportunities. And for those listening in, if you want to get more information from Erik or the companies on his radar or some of the deep dives he does, definitely click on the link below in the show notes. It takes you right over to thehedgelesshorseman.com. And Erik, as always, looking forward to our next conversation.
Thanks. The same, Chad, and keep in mind, I mean, all these high risk, high reward stories. I mean, I'm not betting the farm on any of them. They start small, and if they do well and de-risk, I mean, it's okay for the positions to get bigger. Oh, and I also own shares of all companies mentioned, I think. And some might be banner sponsors as well. Red Canyon is, so consider me twice biased in that case.